it is knowing for every dollar we spend, how much are we getting back. It is easy to calculate. We just need to divide the cash inflows by cash outflows, and it gives us the profitability index number. Let's do the calculation here. Okay, in this example, we need to calculate the present value for the year 1, 2, 3, 4, and 5 and sum them up, and that gives us the value of all cash inflows. And here we have cash outflow. We just need to divide the cash inflows by cash outflows, and it gives us the profitability index. I have done the calculation here and got the cash inflow as 26,814.29, and we know the cash outflow is $25,000. So if we divide 26,814 by 25,000, we get 1.07. And since the profitability index is greater than 1, we can accept the project. And I did the same calculation here in Excel, so you can download the presentation and you can refer to the sheet. Okay, and now let's look at the last technique of the capital budgeting, which is payback period. As the name suggests, it is the break-even point at which we can recover our initial investment. Here are some of the criteria for payback period. A good project will not only have a good net present value or the internal rate of return, but it also will have an early payback period. Let's say you have two projects, and if all the values remain the same, such as the net present value, the internal rate of return, or profitability index, then your criteria is the early payback period. Having an early payback period means you can recover your money early and you can invest that money into other projects. Okay, as I have mentioned earlier, for payback period we will not consider the discount rate. Okay, so let's look at the example. It's the same example we have looked into for profitability index. Let's now calculate the payback period for the same example. So what we need to do is we need to figure out when we can recover our investment. The initial investment is $25,000. In year 1 we recovered $5,000, and in year 2 we recovered $9,000. So in total we recovered $14,000 till the end of year 2, which is nothing but the sum of 5,000 plus 9,000 in cumulative numbers. And using the same cumulative addition, by the end of year 3 we can recover $24,000 in total, and that leaves us with $1,000 more to recover. So by the end of year 4 we can recover up to $34,000. Since we only are concerned with recovering $25,000, what we can do is we can break the $10,000 in the year 4 by month wise. So it will give us $833 per month. So going by this logic, we can recover our investment in about 3 years in 2 months time. So with this, we finished the calculations on capital budgeting techniques. So on the screen, there are a few tips to make a note of from your examination point of view. I think this is important, so I have collated them here. This is in the presentation. I just wanted to put them all in one place for your convenience. It is in the PPT anyway. If you like to download the PPT, you can visit the link in the description section and then download it. So let's do a quick recap as to what we have learned in this video today. We've started with the definition of what is capital budgeting techniques. We looked into the financial management overview. We learned about opportunity cost, which is nothing but the discounted cash flow. We learned about time value of money, with which we can calculate the future value and the present value using the one and only formula that we have. And then we did a couple of examples on net present value, internal rate of return, profitability index, and payback period. And if you have any questions, just leave it in